I don't think that one measures safe haven in weeks. I began systematically saving it. Well, I began to pretend to systematically save in gold in the 70s, except for I wasn't, I was more of an investor and a speculator than I was a saver. Uh, from the time I developed a lot of surplus capital, which was the beginning of this millennium, I began to systematically save in gold and maintain liquidity in US dollars. And my experience in the last 25 years, 26 years now, has been instructive. Gold has generated almost a 9% internal rate of return annually in my portfolio, which is to say it has kept pace with pricing levels. When as I do, informally look at my income expressed in gold, my assets expressed in gold, and my costs expressed in gold, I'm surprised at how cheap things are. Real estate measured in gold is cheap. Food measured in gold is pathetically cheap. Health insurance and health care measured in gold are cheap. When by contrast I measure them in US dollars, all of those things are frightfully expensive. That tells you gold's true role. The recent decline in the gold price tells you something else ironically positive about gold. It was a source of liquidity in times of need. The Turks in particular needed to sell, well, believed they needed to sell their gold to defend their currency, to keep politically expedient domestic pricing low. And they were able to do that. Had the Turks gone to the global bond market and tried to borrow any currency in the world, but particularly Turkish lira, they would have been singularly unsuccessful, given the fact that they had 60 tons of gold to sell and sold it. They weathered the storm. And there's a real lesson there. Gold has spectacular liquidity 24/7 in any markets. You may know, you can see my logo. I'm the founding shareholder of a bank, Battle Bank. And one of our premise is that we love to lend against gold as a piece of collateral. We love to lend against that collateral because we can perfect and sell that collateral if somebody didn't pay us back anytime, 24/7, in any quantity. It's really unique in that regard. It would seem to be a substance that maintains, in a real sense, its purchasing power. And it's also uniform and insanely liquid. It's volatile in price in the near term. But if you look at any other asset that you have in your portfolio, they're volatile too. If you look at currencies, various different currencies, and you measure them against a basket or against each other, they're volatile. If you want to see real volatility, look at your home. Have your home appraised by 3 different appraisers, and you will find at the same minute of the same day that the price of your home, according to a non-market transaction, which is to say an expert, varies by as much as 10% per second, depending on the valuer. So I think this is going to sound trite. I think including gold in one's savings portfolio is simply a matter of sanity. I don't think that there's an excuse for not holding it. Whether or not gold is an investment class or a speculative class depends more on the investor. But as a savings class, a savings or insurance class, I think not holding gold is irresponsible.
Simply a matter of sanity. This example that you gave of Turkey selling a significant amount of their gold holdings is very interesting. Luke Groman has been making an argument on X of these Gulf countries that effectively are getting an enormous liquidity crunch, significantly less income from oil revenues, higher expenditures as a government. Therefore, they might sell what they could get their hands off. Do you think this is a headwind we should account for with gold over the next few weeks to months potentially?
I guess it depends on your outlook. I own a lot of gold, and a financial planner would look at me as the largest shareholder in Sprott, in effect a financial services brand name for gold, and that planner would say, Rick, you are crazy owning gold. You don't need any gold. But I'm an old man. Gold allows me to sleep nights and stay calm. My gold isn't for sale at this price, so I would like to see it cheaper. Where people who are speculators and investors are afraid the gold price might fall, those of us who are savers are hoping the gold price falls. Given that a move in the gold price from 4,600 to 4,700 or 4,800 would not benefit me because I wouldn't sell, I would prefer to see gold fall $400 or $500, in which case I would be a buyer, as opposed to go up $400 or $500, in which case I wouldn't be a seller. So I really think it depends on your perspective. I hope, not for the benefit of citizens of these Middle East countries, but for my own benefit, I hope the gold price falls.
Were you a buyer recently when gold dipped from about 5,500 to 4,300?
I was a buyer in January when I sold 80% of my physical silver. I had that silver in a speculative account. In other words, the role it played for me was speculation. And when silver went from hated to loved, when there was that parabolic up move, I sold 80% of my silver. And I put 25% of the sales proceeds into savings, which is to say I put it in gold. If I generate more liquidity, I likely will continue to overweight gold relative to short-term U.S. cash, which is my other savings vehicle.
How do you think about silver currently? Of course, since you made that call in early January, silver had an incredibly skyrocketing process upwards and a significant fall following quickly after. Is it again attractive right now?
Not for me, not as a speculator. I believe the next 10 years will unfortunately be good for the gold price. I say unfortunately because circumstances that are good for the gold price are usually bad for credit markets, and credit markets are where people live. And I suspect that over the course of 10 years that silver will outpace gold. I have always regarded for my own portfolio, and this is always personal, silver to be a speculative asset. And there are other asset classes within speculation that I prefer to silver. So for me personally, unless we return to a situation which we saw 4.5 years ago, when I was first interviewing with Palisades Gold, where silver was hated, I wouldn't be a buyer. I remember 4.5 years ago, after the aborted silver squeeze, silver below $20 an ounce, and I remember looking at the internet discussion groups where 9 out of 10 commenters on gold were hugely negative, hugely negative. I love circumstances like that. I love circumstances where a commodity for which there's ongoing demand experiences rank hatred. There's nothing in the world I like as a speculator more than hate. And so until and unless we saw that circumstance back in the silver market, which I don't anticipate we'll see for 12 or 15 years, I won't be a silver speculator. I will note that if we dial ourselves way, way back in history, probably before you were born, 1975, in the midst of that wonderful bull market, 1970 to 1980, where the silver price ran from $1.50 to $50. I mean, a truly, truly remarkable run. In the middle of that, the early part of 1975, the gold and silver prices both fell by half. And there was a 5 or 6 month period where in the midst of that just spectacular bull market that silver returned to being hated again. So I wouldn't rule out a situation where, as a response to higher interest rates probably in the U.S., if that occurred, that both the gold and the silver price would be derailed temporarily and would experience real hate. Certainly in 1975, there was widespread hate of gold and silver, particularly among the people who were new adherents to it in 1974 and got high-sided. And if that occurred, I might return silver to my portfolio in a speculative place.
Rick, in your search for utter hatred, is there any commodity currently that fits that bill?
Sadly, no. We have run out of hate. The only hate that is expressed in the market right now is geographic. There are places in the world that are still hated, mercifully for me. The one that I would most like to take advantage of, Russia, I can't because of political constraints both in Russia and the United States. But there are other parts of the world that are hated. If I were still a real estate speculator, I would be in Dubai and Abu Dhabi and Qatar in a flash. There's nothing that engenders fear quite so much as war. Probably, were I allowed, I've tried to do this for 30 years without success. Probably I would look to invest in Iran. Certainly a hated place with evident risk. But the truth is that Western investors are overly concerned, I think, about the political risks in a lot of places that they can't pronounce or spell, mostly because of ignorance. I'm not suggesting that those places aren't risky. I'm just suggesting to you that they are not as risky relative to the US and Canada as they're priced, which is to say, I think the US and Canada are more risky than people give them credit for being. I think Scandinavia is riskier than people give it for credit for being. And so when I look at the relative risk between Sudan and Congo and Brazil and Indonesia relative to Europe and North America, I'm attracted to the risk-reward parameters. In fact, the only classification of oil companies that I'm still actively trying to buy are conventional explorers. The world likes the shale plays. Offshore, the world likes onshore. In frontier and emerging markets, places that other people can't spell. Unfortunately for me, the shares of those companies, which were really in the dumpster in November and December, are up 30 or 35% as a consequence of a higher oil price. And so right now, my bids for them are unrequited love.
What about precious metals miners? Do you still own a significant stake in those? And if so, where would you say the value proposition is currently at?
A lot. I own a lot. When I sold my silver, noted that the silver miners were priced on Wall Street and Bay Street using an approximate $45 per ounce price of silver, which is $75 seemed too cheap. So half of the money that I raised selling my silver, I put into the silver miners. The arithmetic to me was if the silver price kept going up, that the miners would go up with the silver price. If the silver price went sideways, by definition, I'd make no money on the silver, but the silver miners were priced at $45, so I could still make substantial profits in the silver miners. And paradoxically, if the silver price fell, that there was some shelter in the silver price as a consequence of the fact that the equity prices were discounting $45 silver in a $75 world. That circumstance exists today. In the gold markets, I'm of two minds. My instinct tells me that over 10 years, the beta in the gold market, I would define beta as the difference between the performance of gold equities relative to other equities, will be significant and substantial. And part of me says at my age, when I ought to be retired, that I should confine my activities to the biggest and best companies, the Francos, the Wheatons, the Agnico Eagles, because I think they're going to do spectacularly well with relatively little company risk. But the valuations of those companies relative to the best of the best in the other sectors are high. And an investor like me who is patient and disciplined and educated should be coming down the quality trail. If he is a he, pardon me, I was a Californian there for a minute. If he is a he, should be looking as an example at single asset producers, which are viewed rightly by the market as more risky than multi-asset producers, but the discount goes away if they get taken over. I mean, immediately. The whole circumstance that we're seeing in the gold equities chain is that the larger producers have more liquidity, more trading volume, and higher share prices, and the rest don't. If value arbitrageurs don't come tighten the spreads between the big companies and the small companies, the market will. The big companies will take over the small companies. I think we're going to have an M&A streak in mining. Witness the recent G-Min takeover of G2 at a 72% premium, yet still accretive. That'll tell you how much room there is in the next 3 years in the gold mining space. In terms of expressing that, mercifully for me, I expressed it 4 years ago, 5 years ago. And if you looked at my own portfolio in an allocation sense, you would see a gross over allocation to gold. So I don't need to go deeper into the space.
You can just continue to rotate. Well understood. Some would argue the juniors have moved less than you would expect, actually, with how much move we have seen in the underlying commodities of gold and silver. Do you think there's a credence to that? And does that mean that there's indeed a catch up value investment to be had, like you outlined there earlier?
Sadly, you're asking me very good and very nuanced questions. I prefer dumber questions, but let me try. I will start by saying that if you merge every junior gold explorer in the world into one company, Junior Explorco, that company would lose about $2 billion a year. So what should you pay for that company? 10 times losses, 12 times losses? In a bull market, maybe 15 times losses? The point is that the junior mining industry is always overcapitalized because as an industry as a whole, it's worth nothing. It's worth less than nothing. It destroys capital. That belies the fact that the best 10% of juniors generate so much value that they add legitimacy and even luster to a sector that loses between $2 and $5 billion a year. So it's a stock picker's game. The overall junior market is hopelessly overcapitalized. I mean, hopelessly overcapitalized. It's probably 1,500 companies worldwide, and there's probably 200 that are viable. Now, that doesn't mean that in an increasing gold price, that the Vancouver used car salesman won't be able to, tweet stuff out about amalgamated moose pasture and how the gold price is going to go up. And it doesn't mean that those shares won't do well. But in terms of the juxtaposition between price and value, the only way that you can afford to speculate in that game is by really learning a lot about the underlying value of the assets, doing the work. You may know that I've graded now over 35 years almost 100,000 portfolios. And I've learned an awful lot about the mistake that individual speculators make. Much too narrative oriented, much too lazy, own way more stocks than they can follow, much too impatient, not tenacious enough, making money in junior explorers, which is one of the sort of roots of my own portfolio, involves doing a lot of work. It involves holding for 5 or 6 year time frames during which the individual equities can fall 50% in price or more without derailing the value story. Most speculators aren't willing to do that. And the consequence of that is that most speculators, if they did an honest self-assessment, wouldn't, or at least shouldn't, speculate in the junior sector. For those of us who do, it could be a truly, truly, truly wonderful place, as my own portfolio testifies.
So you mentioned earlier, single asset producers very attractive place to be looking for value arbitrages compared to the majors. What about developers? Are they still trading at attractive prices if you compare it to NAV?
I wouldn't like to suggest that all developers are equal. There are developers, as an example, who are amalgamators. Let's call them Bay Street developers, more financial jockeys like myself than engineers. And participating in their game is very, very risky. It could work, but it's very risky. What you look for in a developer is track record, and track record around specific expertise. G Mining is an example, the people who just took over G2. The Gignac family has been involved as mine builders and contractors for 40 years. And they have developed a subspecialty in constructing gold mines in orogenic settings in tropical, remote locations with high rainfall. Well, guess how they built G Mining? They built high-quality gold mines in orogenic environments, in tropical, high rainfall environments. In other words, they stuck to what they did. The consequence of that is that the stock is up tenfold in 3.5 years and is still, from my point of view, undervalued. So when you say developers, there is not a one-size-fits-all answer to your question. Certain developers, the people who have access to capital, who know what they're doing, and are sticking to their regional and deposit expertise, can be expected to do very, very, very well. The Bay Street Cowboys, ultimately always round trip. The stock goes up and the stock goes down, and that process of falling is a lot less pleasant if you're long than the process of it going up.